Welcome to the Deep Dive. We're here to break down the critical insights from corporate earnings calls, making sense of the numbers for you. Today, we're looking at Wrtsil, the Finnish tech giant, after their Q3 2025 results dropped.
Yeah, and this one's really interesting because, the Wrtsil results were a bit of a paradox, weren't they? You had this fantastic operational performance, really strong cash flow.
Record cash flow, even.
Exactly, record cash flow. But then, boom, a big miss on revenue. And the market, well, it reacted pretty negatively right off the bat.
It did. Shares dropped, what was it, 2, maybe 3.5% in early trading.
Yeah.
Which, makes sense if you only look at that top line number.
Right. So our job today is to get under the surface, figure out if that pessimism is justified or if it's just maybe an accounting thing, a timing issue.
Okay, let's nail down those headline figures first. What did we actually see?
Well, the bottom line was actually pretty good. GAAP EPS, that's your earnings per share, came in at 10.31. That was comfortably ahead of what analysts expected, around 0.26.
Okay, so a beat there.
A solid beat. And the margins were, frankly, exceptional. Comparable EBIT, that's earnings before interest and taxes, hit $195 million, also beating the consensus of about $191 million.
And the margin percentage?
That's the really impressive part. Comparable EBIT margin jumped to 11.9%. That's up 10% compared to last year. Shows real discipline inside the company managing costs.
But then the friction point, the top line, the sales number.
Yeah, that's where the miss happened. Net sales were $1.632 billion. The market was looking for something closer to $1.750 billion. So a decent miss there, and it meant sales were actually down 5% year over year.
And that's what the market immediately seized on, that decline.
It's that classic split, isn't it? Great operational performance, strong profits, amazing cash flow, which we definitely need to talk more about, but it all got overshadowed by that sales number.
Still, there were positive signs in the pipeline, right? The order book.
Absolutely. The book-to-bill ratio was strong, came in at 1.10x, and that's, I think, the 18th quarter in a row where they've booked more new orders than the revenue they've recognized. So the underlying demand is definitely still growing. It just didn't all translate into this quarter's sales figures.
Okay, so the CEO comes out on the call and says investors need to look a little bit under the hood. Is that just standard damage control when you miss on sales like that?
Well, it could be spin, But you have to look at whether the core business is actually weak. And in Wrtsil's case, it doesn't look like it. That's why we need to dig deeper. So
what's under the hood then? How did the segments perform?
The core engine businesses are actually doing really well. Order intake in the marine segment, up 8%. And in energy, that's the bit that builds power plants. Orders surged 29%.
29%, wow.
Yeah, huge jump. So that strength means their total order book is still massive. It's sitting at $8.637 billion. That gives them visibility for years, really.
So if the orders were flooding in for the main businesses, what caused that air pocket in Q3 revenue? You mentioned a strategic shift earlier.
Yes, and this is really crucial for understanding the numbers. Wrtsil is deliberately moving away from what they call EPC contracts, engineering, procurement, construction.
Okay, and those EPC contracts, how did they work for revenue?
They allowed for smoother revenue recognition. Basically, Wrtsil could book revenue based on the percentage of work completed on a big project, like getting paid gradually.
Right, makes sense.
But now they're shifting more towards pure equipment contracts.
And what does that mean for the quarterly numbers for investors watching?
It means revenue gets really lumpy. Think of it like this. EPC was getting paid steadily as you build a house. Equipment contracts mean you only get paid the full whack when you hand over the keys. Revenue only gets booked on delivery.
Okay. So delivery slipping from Q3 to Q4 would have a big impact then.
Exactly. Management basically said that's what happened. Several big deliveries in the energy segment, things that were supposed to wrap up in September, just slid into October or November. That timing shift created the Q3 sales gap.
Which actually makes that 11.9% EBIT margin even more impressive, doesn't it?
Yeah.
If they did the work and incurred the costs in Q3 but couldn't book the revenue yet.
Precisely. The operational work got done, the profit was generated. It just couldn't be reported as revenue in Q3 because of the contract type and accounting rules. It's deferred.
Okay, but it wasn't all just timing. There was one segment really facing headwinds, right? Energy storage.
Yeah, that's the tricky spot. Order intake for new equipment, there was, and I think this was the quote, basically zero in Q3, down 79%. That's Well, that's a big drop.
And what's driving that?
Management was pretty clear. It's the new U.S. tariffs and these things called FEOC restrictions, foreign entity of concern rules. It's thrown a lot of uncertainty into the U.S. battery supply chain. So customers are hitting pause on big new orders until things become clearer.
But again, the operational story seems different even there. Despite 0 new orders, the segment was still profitable.
Right. That's the counterpoint. The energy storage segment still delivered a 6.9% EBIT margin, which is pretty strong.
How, if there were no new orders?
Because they executed really well on the orders they already had in their backlog. It shows that even with the geopolitical issues stalling new sales, they can manage and deliver their existing projects profitably.
So the capability is there. It's the new order environment that's tough, specifically in the U.S.
Exactly. And management did sound cautiously optimistic. They pointed to a big new order they just got in Australia as proof that outside that specific U.S. tariff issue, the demand is still definitely there. They expect things to pick up in Q4.
Okay, let's shift to the broader investor picture then. Revenue was shaky because of timing, but you mentioned cash flow was exceptional. Let's break that down.
Yeah, this for me is maybe the biggest story from the quarter. Operating cash flow hit $340 million. Management said that's the highest figure they've seen in at least 15 years.
15 years, wow.
And linked to that, they made a really important shift in how they talk about working capital. It's currently negative, approaching $1.1 billion.
Negative working capital, meaning they have more current liabilities than current assets, essentially getting cash from customers and suppliers before they pay their own bills.
Exactly. And historically, Wrtsil was always a bit cautious, saying this negative trend might not last. But now, they're saying they're confident it's sustainable for the next few years. That's a big change in tone.
What changed? Why are they suddenly confident this is sustainable?
It ties right back to that strategic shift we talked about, moving to equipment contracts. Because they're selling equipment, not long EPC projects, they can demand more cash upfront from customers.
So bigger down payments.
Bigger down payments, especially for things like marine engines or power plants where shipyards or customers want to lock in costs early. So Wrtsil gets the cash flow long before they have to deliver the final product and recognize the revenue. They're effectively using their customer payments to fund operations.
So the very thing that made Q3 revenue look weak, the shift to equipment contracts and lumpy recognition, is also driving this incredible sustainable cash flow.
Precisely. It's two sides of the same coin. And this financial strength, it really changes how you might look at the company. Their ROCE, return on capital employed, has climbed above 50% now.
50% ROCE is huge.
It's not just good, it's transformative. Numbers like that suggest Wrtsil isn't just a standard industrial company anymore. It's operating more like a highly efficient capital-light business.
Yeah.
That's a really powerful narrative for investors.
Okay, let's look forward then. Strategic positioning. Decarbonization is obviously huge, especially in shipping. Wrtsil launched something new there.
Yeah, they commercially launched an onboard marine carbon capture system. It's a big deal technologically.
Carbon capture on a ship. How effective is it?
They're claiming up to 70% FICO Euro reduction, and the key thing here is optionality for ship owners. The global rules from the IMO on emissions got delayed, right? So now you have this patchwork of regional rules like the EU's ETS, maybe future US rules.
So as a ship owner, you're facing uncertainty. This helps navigate that.
Exactly. This system lets them meet various regional carbon rules now without having to bet the farm on, say, ammonia or methanol engines before the fuel is even widely available or face massive fines. Wrtsil's tech becomes a bridge.
A transition technology. Makes sense. The infrastructure for widespread capture and storage isn't quite there yet, presumably?
No, the whole ecosystem, sequestration sites, onshore handling needs to develop. But having the onboard capture unit ready now gives Wrtsil a significant first-mover advantage in that space.
Interesting. But maybe the even bigger driver, right now at least, seems to be the data center boom.
Oh, absolutely. Management really hammered this point. The sheer amount of power needed for new data centers, especially AI-driven ones, is just skyrocketing. And crucially, the grid often can't keep up.
So the hyperscalers, the big cloud companies, need their own power.
They often do. They can't wait for the local utility to build new capacity, so they're increasingly looking to build their own dedicated off-grid power generation.
And Wrtsil sees an opportunity there. Did we see evidence in the Q3 orders?
Yes, very clearly. There was that order for a 217-megawatt dual-fuel power plant in Kentucky, specifically highlighted as being for data center-related demand. Wrtsil's sweet spot seems to be these larger projects, maybe 100 to 400 megawatts.
And why Wrtsil's tech? Why their engines versus, say, traditional gas turbines for these data centers?
A couple of key advantages they highlighted. One is higher energy efficiency with their multi-fuel engines. Two, and this is critical, their engines don't lose power output, they don't derate at high altitudes.
Ah, important for inland data centers, maybe in mountainous regions.
Exactly, places like the U.S. West. No derating means reliable, maximum power, which is non-negotiable for these data centers. And third, their engines use much less water than gas turbines, which is a huge plus in dry areas.
So efficiency, reliability, low water use. A strong package.
It seems to be driving real acceptance for their engine technology in this massive growing market.
Okay, looking ahead then, the next 12 months. Management sounded pretty confident about demand.
Very confident. They guided for marine demand to be better than current levels. For energy, they said similar, but remember Q2 was a record high, so similar means staying near the peak.
And energy storage, despite the Q3 dip.
Still guided better over the next year, while obviously acknowledging those tariff risks we discussed. It's a strong outlook, really underpinned by that massive $8.6 billion order book.
Right. Okay. Before we wrap with a summary, it's time for our not financial advice segment. We've dug into the numbers, the strategy. What's the speculative, maybe slightly outrageous, but plausible trade idea based on all this?
Okay, usual disclaimer first. This is purely for discussion, for entertainment, definitely not investment advice.
Understood.
But look at the setup. The stock took a hit because of a Q3 revenue timing issue, right? Not because the business suddenly got worse operationally.
Right. The margins, the cash flow, they prove the operational health.
Exactly. That 11.9% EBIT margin, the record cash flow that proves the machine is running well. So the market seems to be punishing a schedule slip, potentially underpricing the likelihood of that revenue catching up in Q4.
So the trade idea is betting on that Q4 catch-up.
Pretty much. A short-term options play, perhaps, positioned to capture that volatility. You're betting that the delayed energy deliveries do land in Q4, as management guided. You're betting that the energy storage backlog keeps executing profitably.
If that happens, Q4 revenue could look really strong compared to the negative sentiment lingering from Q3.
It could deliver a significant beat relative to current, maybe overly pessimistic expectations. You're essentially making a trade based on Wrtsil's execution capability, which they demonstrated really well this quarter, ironically, and the simple normalization of delivery schedules. It feels like a potentially mispriced opportunity based on timing versus fundamentals.
Interesting. Betting on schedule normalization after the market reacted to the slip. Okay, let's summarize the key takeaways for you, our listener. Wrtsil's showing real financial strength. That sustainable negative working capital ROCE over 50%, record cash flow. That's a big positive shift.
Yeah, and demand in the core marine and energy segments is strong, fueled by big trends like decarbonization and especially that data center power boom.
The main headwinds look temporary. The Q3 revenue miss seems mostly timing related to that contract shift, and the energy storage weakness is tied to specific U.S. political tariff issues, not a collapse in global demand.
Which leads us to that final provocative thought for you to chew on. Wrtsil is deliberately choosing lumpier, less predictable quarterly revenue in exchange for much stronger cash flow and a rock-solid balance sheet.
So the old way of just tracking quarterly sales might not work anymore.
Maybe not. Does this strategic shift mean investors need to fundamentally change how they value a company like this? Should the focus shift much more heavily towards cash flow generation and the sheer size and security of that multi-year order book, rather than obsessing over whether revenue hits the mark perfectly every single quarter? It's about valuing the pipeline, not just the quarterly output.
Something to definitely think about. Excellent context. Thanks for breaking it all down.
My pleasure. Thanks for listening, everyone. We'll catch you on the next deep dive.